Okay, so let's talk about trading a little bit, right? So I've probably been through every gamut. I've been trading best part of 5-6 years, and I've gone through every different trading style. Had a look at the SMC, very much into liquidity, always kind of traded with liquidity. You know, even when you go back to basics, starting with levels and EMAs and stuff like that. And whilst they all have a place, one of the most difficult things as a trader is once you get too many ideas in your head and you can't process all of the different information that's coming through, you tend to just second guess yourself a lot, and it makes it, I think, more challenging to be a trader. And you may get varying results, you may feel like you've got a system that works. Problem is, we often get greedy, and always, at least in my case, it tends to work for a bit, and then for whatever reason it will just seem to fail. And so I'm going to show you the most simplest system, and it just works. There's a couple of things that you need to be mindful of when you're doing this. You need to be savvy with risk management, because it's a different approach than probably what you're used to, because we're not using stop losses, but we are protecting our account. And so that's important factor number one. Important factor number two is being able to identify key levels. I'm currently on the 4 hour right now. Let me just go to the 1 hour. And what I'm looking for is just a zone. It doesn't have to be perfect. We're not aiming for perfection here. We're just aiming for what appears to be, you know, a zone where we have some level of consolidation, where in the past price is respected, and so it's a 50-50 toss up, right? Are we going to bounce or are we going to continue? And that's all trading is. If you look at price action, it's a simple binary answer. Is it going to go up or is it going to go down? So that means 50% of the time you're going to be right, and 50% of the time you are going to be wrong. And so I want to go over how I've completely disregarded all of my years of experience in everything I've done from trading, where I've gone uber technical, tried to be the best analyst and, you know, whatever, and basically throw it out the bath, because I just think, you know, it's not for me. I'm just getting fed up trying to trade in ways where I'm not really doing myself justice. And so what I've done here, I'm on the 1 hour, and I've mapped out key levels. Now this specifically probably doesn't look like a key level unless you widen that out. And so I've mapped out the zones where we have some sort of a rejection, some sort of consolidation. Like you can clearly see, this is a consolidation zone, although one would probably argue that this is messy and maybe that's not what you want to do. So maybe if I look at this, you know, this zone could probably move up a little bit to catch these and these and these. And so how do we do it? So right now we're in between two zones, okay? And what I've done, I've created alerts. I'm actually going to move this alert up a little bit just to kind of give me a note, because what I don't want to be doing is staring, looking at the charts all day. I just want to know when I come into a zone and I'm about to approach the zone to give me a nudge. I just want someone to let me know. Now where this comes into play is you can do this across multiple different tokens. So it could be ETH, BNB, Matic, any kind of token that's, you know, got a good amount of liquidity. That means you can, you know, not just be sitting behind the screen, but wait for an alert to come in, and if it comes into a zone that you like, then you just simply play that zone. So how do we do it? So it's a reversal based strategy. More often than not, you are looking for places where you think it's going to be reversed. It's always got to be under context, right? Like if the market's like from here going down, so you'd say the context of the market is down, yeah? So, you know, I wouldn't be looking for reversals in a uptrending market. I'd be waiting for pullbacks, yeah, rather than the opposite way around. So how do we do it? So right now I've got an order in the zone at here, right? So I'm going to color that red. So that would be the first zone that I will enter a trade, yeah? The next place I'm going to enter a trade is going to be the invalidation of this idea. So I think it, you know, my 50-50 chances it's going to come up here, hit the zone and reverse down. If it does that, if I come up to here and then we go down to this zone, I'm going to be taking profits. This zone, because we've got this kind of, we've mapped this out. Great. One up apex. But what happens if it doesn't hit the zone? What happens if price triggers my trade as a short, maybe comes down a little bit, but then moves up to the upside? Well, the way in which I manage this is through a hedge, and so the invalidation of this zone for me would be kind of around here, right? So I don't want to go too crazy, but I'm going to say 27k, right? So somewhere around here. Don't have to be perfect. This is going to be order of a long, and this would be a conditional order, because you can't place limit orders above. It would just take whatever the price is. So you've got to set this as a conditional order. And so now what would happen is the following. We would have price would come up. Right now we'd be in drawdown, yeah, because we are past that price, which makes sense because we've got one. Let me just do that properly. We've got one order that has gone past this zone. Remember, I'm only in positive equity when price comes below here. So let's say the price continues to go up. I've opened up a short. I'm now in negative equity, but now I'm going to open up a conditional based long if we pass this threshold. So what would happen if we go there? As it stands, I've got a short open here and I've got a long open here. The short and the long are evenly matched in terms of position size, and that's the key. You've got to map out and make sure that these are the same. And so let's say, if I want to calculate, the way you would do this is you need to calculate what your position size is relative to what your account loss is. So let's say I've got a $1,000 account as an argument. That $1,000, I might say, okay, I only want to risk 5% on every trade, so that's going to be $50, right? So each trade would be a $50 risk. And so what I need to do is I need to map the distance between here and my invalidation point, which would be here, to the tune of $50. Now that would tell me, if I go into any kind of lot size calculator or any kind of calculator, what the position size would be in order to give me this invalidation size. In fact, if you just give me a second, I'll go through it right now, right? Okay, so over in Google, I just type in calc.trade as an example. And what I'm looking to do is, let's say I had a $1,000 account. I want to risk 5%. Okay, so if I head back over to XO, well, what did we say? So on XO, we've said we're going to put a short entry at 26,765. Let's make it nice and easy. We want a short, right? So $1,000, 5% risk. Entry is 26,769. Okay, and the stop is the invalidation zone, right? So that's the point at which we'd say, okay, normally I'd have a stop loss here. However, if I hit this price, effectively what I'm going to do is I'm going to bow out, or in our case, we're going to go long. Yeah, so that's 27k. Not bothered about an exit right now. Our risked capital on a $1,000 account is $50. Our margin, ignore that for now. Is the key thing. That was the position size, right? So the position size means that the value between entry and exit is no more than $50 risked, okay? And that's essentially what we want to do. You can change it to 10%, and that would be $100 risk. And you can see obviously the position size changes, but we don't really want to go more than 5%, and I'll explain why that's important in a short while. But the key for us is understanding the position size. That's what we need to know for knowing what our kind of threshold and limit is for not being too risky. So just to go back quickly to that page, so you can see I've gone $1,000, 5% risk. This is going to be a short entry. On the leverage, you just want to make sure that your liquidation point isn't lower than your stop loss. So it doesn't really matter, it's arbitrary figures anyway, so just make sure you leverage, because you go on position size, it doesn't really matter. You just don't want to be liquidated before your position size. So you can use this calc.trade to figure that out. We're just interested in the margin. Okay, heading back to XO charts, or trading view as it were, we can see on the chart itself, these are our entries. So going back to this kind of case in point, so right now we are locked in. Okay, so we've got to raise this entry. That's now raised our effective outlay to $100 in this scenario, right? So we put $50 in here, and we had another $50 order here, but that $50 is now locked in the sense that irrespective of which way the price goes, up or down above here or down below there, we've got that same price locked in. So you know, the price could drop to infinity and we'd still only lose $100 because we're locked in at a price. And so the art of this really is to try to figure out where do we go, how are we going to unlock ourselves from our hedge. And so let's say price, you know, does a little bit of this. Let me just map that again. You know, price does this, comes back into the zone, doesn't really do anything, but then it comes to this zone. Okay, so by the time it's come to this zone, remember the key is mapping out the zones where you anticipate some form of a reversal, and it's always about context. It's pointless getting stuck into these if you're going against the grain, the major trend, because it's never going to work. You're gonna get locked out. So what you do here is, remember, we've got $1,000 account. We're now kind of registered for $100. Okay, we've got this long in a positive equity and the short is in a negative equity, negative $100. Yeah, in net positional sense, got positive here, negative here. Now what you do is, this is the next zone, and so okay, now what you're going to do is short. So you're short at this zone, right? Cool. So now we've got a short. Let's figure out our positions. So we've now closed our long position. Okay, that's gone. But remember, we've taken the benefit of that long position because it was a win. In fact, let me just leave that in because that's relative. And then what happens is we've got a short here and a short here. So we're obviously still $100 in negative equity if we take our account size as a whole. Then what you're looking for is, does price start to bounce back down? Now, obviously this green one is closed, but if price comes back down to here, anywhere, you're going to be 50-50 at this point. So, you know, when you've got in, if the price continues to come back down and hits this zone, then the bonus here is that you've already taken the positive side from the long, from your original hedge here. You've got a short that's still open, and that's fine. You've also shorted at the top, but what you're also going to have again is another hedge. You know, at what point would this then become invalidated? So, you know, you would have another hedge here as a long. You know, but if price does come down, the fantastic thing about it is that as prices approach this level, you've closed this long. So you've realized that unrealized gain is now a realized gain. But of course, you've amalgamated these two shorts. So the average, let's just say, would probably be somewhere here. I'll just do that as a white. So the average between, because they're both going to be the same size, yeah, is going to be 50-50 in these points. So you've got two options. You can either hope that price comes back down here, in which case this would be neutralized, or break even. But remember, you've also taken the net position from the long, or you continue to hold the position in the hope that it comes back down, or even, you know, further down to your position. And at what point you either close here at a neutral, you know, a break even, or you let it run down, in which case you've profited from the long because you hedged, and now you're back in either neutral territory, so net positive overall, or you are in positive territory again because the short has passed the halfway point and gone into the next zone. And so what have I actually done? All I've kind of speculated is that I have zones at which I would anticipate, you know, reversal. I have gone with my initial idea at a zone that I'm expecting a reversal, and it's 50-50, right? It either hits the zone, doesn't hit your invalidation point and reverses, everyone's a winner, or it goes to the next zone, but then you hedge again. And so what does this give you, by the way? So let's say I had 20 zones, right? 20 reversal zones. You know, the reality is you only need to you only need to get down one level to effectively break even each time. And so, you know, if I've got my hedge position, so I'm going to go short here, that's going to be short. You know, I'm trying to work out this to the worst degree. Okay, and then I've hedged here as a long. Okay, but prices continue to move to the upside. So now I'm in a hedge short position. Sorry, a short of the gain at this zone. Okay, so now let's calculate the math. $500, $1,000. Close the long, so retained $500 back here. Okay, so let me just delete that, because I would close, if I'm going to put a new position here, I'm going to close the long. So now I'm $500 off here. I've made some profit, undeterministic. I don't know what the profit would be between here and there, but it won't be, it's going off the total loss, let's just say. So another 500 here, so 5, close that long in profit. So maybe this is now 250, maybe not. This is another $500. We've got $50. Why am I saying that? $50. This is $50. Might be down to 25 once we took the long. This is $50. So on a $1,000 account, we are sweating it for about, say, $75. Let's say I have another zone here that I'm interested in, and so I'm going to hedge long here when I think it might be invalidated. Now remember, each time I do this, I've got to recalculate what the position size is relative to the distance between the short and the long, so that it always equates to the same value. That's key, yeah? So I'm now hedged here. I've got my next zone. This will be red. Okay. If price continues to move up, I'm going to close my long again, taking the benefit from the move to the upside. And then either one, I get a reversal. Now remember, each time you add this long, you're going more into drawdown, but equally the position, it's not like this is where we've got to get back to, because your position size averages out. Because it's the same value, your actual average position is always going to be pretty much 50% of that distance of where you are, or it'll be the total amount divided by how many of these ranges you've got to go. And so, you know, it's more often than not, you'll either break even, maybe make a tiny bit of profit, or you will make profit on the run. And so that's, I feel like it's probably been more complex than it needed to be in terms of how I've displayed and showed that. I don't know if, I mean, look, drop some questions, let me know in the comments if that's lost you in any way. But the concept is simple. I think the price might reverse here, right, as an example. If the price doesn't reverse there, but maybe, you know, in my world, I would put a stop loss, you know, here, arbitrarily, right, whatever. That would be my stop loss. And so, like, normally, okay, that's a loss. Take it on the chin. You've lost value in that trade. What I'm saying is the context of the position of where I think the market's going is still correct. And so rather than putting a stop loss, this becomes a long position. And I've effectively, the distance between these two zones here, on this here, right, which is 240 or nearly a 1% move in relative terms, is a $50 hedge, right? So that means that the distance between here and that, remember that $50 is what I'm prepared to risk on the trade. But that gives me, if 5% is my risk, I can realistically have 20 goes of hedging, you know, each time it hits a zone. So you'd have to be incredibly unlucky to get 20 zones wrong in a row without some sort of a retracement, at least getting you out at break even. And so that's how I'm basically breaking it down. I think it doesn't need to be complex. You need to understand risk management for sure. You need to know, you know, my long, these entries here, they are specifically where I think the trade is invalid, and what I'm looking for is the next zone. But instead of it being a stop loss, it's a hedged long, which will just be a conditional based long order with a trigger point. So don't get them mistaken. If you put 2 limit orders in, it's going to open this limit order straight away at the current price if price is above. So the long has to be a conditional limit. The short, if price is above, just needs to be a standard limit order. Now, don't get me wrong. You know, this is, you've got to have some understanding of trading. You've got to have some understanding of levels. You've got to have an understanding of the context of the market. You know, don't just go against the grain, because otherwise you're going to almost certainly be in constant hedge mode, which is not the idea. The idea really is to try to get it right first time round. We hit the zone, we bounce back, we take profit, wait for the hit to hit the next zone, you know, put an alert in, like so, and then just wait for that alert to happen. Once that alert happens, you know, I'm not, this, by the way, this alert isn't for me to make my entry, it's just to signify prices in the zone. Here's where you would normally take some sort of a trade. You can do these on, you know, most tokens. You know, if I change to, let's say ETH as an example, you know, what are we drawing our eyes to? Natural parts on the chart that just signify zones. Okay, so you don't have to be perfect. We're just looking for areas that, you know, give us some sort of sense on some sort of zone, whether that's, you know, previous support resistance, or expand that somewhere around there. So you probably anticipate that actually, you know, ETH might be approaching a zone that you would be interested in playing with. I'll just do a few more. Let's see. Has to feel natural. You know, if the zones are not natural, then they don't belong there. It's, you know, really that simple. It's probably argue that might be a zone there, but I don't want too many zones, because I want to take the long kind of swing trade. So I'd probably you know, stick at that if that was the case. Okay, and so again, you're just going to put your alarms, you know, once it hits that zone. Like for example, right, this zone, you know, we'd have been in a trade right now, right? And so, you know, 2 hours prior, if we drew this zone, we'd have had a short entry here, right? Let's just say, and that will be, you know, a short. The way we'd have it is we would have a hedge loss, probably, you know, at what point you'd want this to be quite high, which is going to affect obviously it's going to affect your position size greatly because of the distance, but it will all be relative to your bag size, right? So, you know, remember, this would still be a 5% loss, and that's going to give you a position size based on the calculator we showed before. The idea is that, you know, realistically, you want this to bounce down to here, and this is your take profit target, nice and easy at the zone. If price goes up here with $50 in loss, but then, you know, nice and easily you are putting another short here, and that short entry will effectively, if we hit this zone, price continues up, we are closing the long, gone. We've now we've taken profit from the long, because even though it's only quite small, and then we've kind of halved our loss here, or not loss, we've effectively doubled our outlay, because we've gone from $50 to $1,500, $50 to $150, because we played 3 trades. However, we took the position of the long off, so that now removes $50 plus the margin we made of whatever that long was. And now reversal only needs to go, you know, past here, and then we've made profit on the long, we're delta neutral on the short, and then if we come back down to this zone, brilliant, we have made, you know, a tardy profit. And so, you know, the magic behind this is that as long as you're hedging correctly, as long as it's contextualized around the bias, let's just say, then realistically you should never really get too much of a loss. You may have to pay a few fees if you're just looking at breaking even, if you've been in a trade, you know, longer than anticipated, but by hedging, you're effectively locking in that profit. So I'm going to be trading like this now indefinitely, because it just works. And so, you know, hit me up with some comments. You can join my Discord server, Apex Trades. The link will of course be in the description, but everything's free. Come over, say hello, ask me any questions, anything I can do to help you guys out, I will certainly do. And yeah, I'll keep on making videos like this if they are useful. Peace.